Hi, folks. It's Aidan CryptoBurb speaking. Welcome to today's Friday webinar. So much is going on right now in the crypto, not necessarily on the positive side of the coin. Tons of people got hurt in the FTX scam collapse. This is one of the wildest situations, and the situation and the scenario that actually, truly speaking, nobody could have ever predicted, to be honest. I personally hadn't been affected much by this, but it's so saddening to see so many people get hurt in there. So I'm going to do my best actually today and throughout this entire next week to try to help you make up and recover all the losses with the webinar like this one and tons of workshops that are coming up within our free trading congress, which is starting next week. If you're ready to actually hear and learn a little bit more about that and where Bitcoin is potentially heading and why $12,000 may be and should be on your maps, well, stay tuned. We're going there right in a second. Welcome, welcome, welcome. Once again, it's Aidan CryptoBurb speaking. This is Friday's webinar, and well, in all honesty, I would say that FTX is definitely on everybody's mouths these couple of days. This has been extremely sad event. Actually, many people, buried their careers. Many people lost shit tons of money. I've really spoken to many of my friends who lost really significant chunks of their entire portfolio. Some people, or even some funds, were holding a lot of money on the FTX, and this collapse actually definitely makes a historical impact on that. And I would put it somewhere in the books, probably next to MT Gox collapse, MT Gox like hack, minus capitulation 2018. So all of that is definitely very sad. But hopefully, for everybody who stays long enough, there is a way to recover. And well, I'm going to do my best actually to help you guys figure it all out. So let's cut it straight to the chase. Um, I would say that one of my tweets earlier today is basically saying that for the first time in 2022 so far, we're talking about a significant trend shift in the way that the markets actually perform, right? There's been this significant shift. We don't know if it's a proper bull market just yet, right? For the bull market, actually, you have to have a lot of confirmation on the breadth. A lot of stocks need to be following the same direction. Of course, Bitcoin, has never escaped this. And why it is like that, where I'm going to actually just cover in a second. But let's have a look for the specific chart list that I've been watching, for why I think there has been this significant shift. And well, starting off with the industrial, Dow Jones Industrials, here you're looking at the chart, which is truly breaking over this red curve. This red curve represents 200-day average, which is a long-term trend. Long-term trend basically saying that, well, for this entire year, of course, we've been decreasing and descending on average. There's been definitely this major mainstream trend to the downside that's been performing and dominant over the entire year. However, we have seen for the first time recently this breakout to the upside that basically takes it where none other breakout this year had taken it so far, right? So we've seen not only the breakout, but an actual bounce and a follow through, right? Of course, it kind of like breached a little bit with weakness here, but still bounced off the 20-day mean, 20-day short-term trend. But overall, what matters is that we've seen the peak, which was made up here, right? There was a peak at 33,000 points. There was a little bit of a resistance. We kind of like took a hit, down, like I said, with a quite a nasty slide below 32,000 points, followed by an actual follow through where there was close higher and higher resistance, right? So this is what defines an upwards trend. We have this resistance that is initially met, this price barrier. It kind of like lets this opposing force act for a moment, and then it follows through, right? And as long as it follows through, this is why we can talk about an upwards trend. So the fact that it's broken, all of those double bottoms patterns up here, with a little bit of a failure from the June's lows, right? We've seen a little bit of this tease. The bears got teased so that the bear market continues lower. However, eventually we were looking at this overthrow, if you will, this liquidity hunt, right? When with a double bottom pattern here successfully reclaimed and broken to the upside, we were truly looking and a couple of exhaustion gaps up there as well, right? I'm mentioning specifically exhaustion gaps, those kind of like congested areas with where the price action is is basically missing in the price chart. Uh, they tend to happen overnight, typically from the moment that the market closes to the moment that the market opens, where we see a lot of volatility overnight, especially on the futures market. This often dictates the way that the market is going to open, leaving those empty slots, those empty windows, gaps, so called. And the more of those kinds of gaps, like here we are truly looking at, then the bigger the chances are that we're looking at a potential reversal, right? So I'm going to actually mention the gaps shortly soon as well. But hoping that all you guys are doing well, I want to um, give you a little bit of thought also outside of the industrial average. So if we go lower, right, for why I think this itself is good, right, because it's a significant bullish breakout first time this year. It's different than the other ones. We're on the energy side, of course. Energy has been one of the biggest performance this year. It's been actually the top performer, right? If you go to the performance chart comparing all the sectors of the S&P 500, then you're looking at a distinct leadership, like here in the upward section, towards the upper right corner, with 70% year-to-date performance. 70% year-to-date performance on the XLE. XLE, which is standing basically for a fund that represents the energy stocks within the S&P 500 energy sector, right? And all the other rest of stocks is basically down there below, right, on the water. So we're talking about the utilities, about the consumer staples, about the more defensive stocks, which are less underwater because 5 to 10% to the downside, underwater below the surface. However, most of the risk-aggressive, risk-seeking stocks, as in technology or communication services, then we're looking at the performance at the rates of 30-20% to the downside underwater year to date. So there is this distinct fissure and an actual canyon, if you will, grand fucking canyon between the performance on the side of the risk assets, of the risk basket of stocks, and at the same time the energy markets, right? However, this may soon have a little bit of an ease, right? Because like I said, we are looking at this exhaustion gap here, right? So similar that we were looking at this a little bit of the island reversal here, we were looking at this local distribution pattern, here a gap down with this tiny little island and a gap up. This is a typical island reversal here, if you will, on the bar chart patterns. That actually pushed through, followed higher. We broke the new highs. The energy is trading basically at the all-time highs for the XLE sector. Okay, for the energy sector. The short-term trend has been defended. However, you are looking at this exhaustion gap. Whenever, like, how do I know it is an exhaustion gap? I know it mainly because it gets filled right on the next day, next week, right? When this is a short-lived event, this is an exhaustion gap because it represents intensified congestion of price action in a specific period, in a specific time, right? It means that there is a little bit of a pattern up here, some sort of like, descending megaphone, broadening wedge, broadening megaphone, whatever you name that. When you see those exhaustion gaps that get filled and it got filled a couple of days later, this is typically a short-term reversal signal, right? I'm not saying it's a full blown out, confirmation. Yeah, we're going like end of the bull market for the energy and going lower like to the fucking hell, right? That's not how it works. However, those early signs of this exhaustion gap, I would say that I would take it that, okay, there's been a very significant push, extremely strong rally on the energy sector, which drains money out of people's pocket, basically leaving less disposable income to invest in the financial markets and the risk stocks, right? So overall, a decrease coming from this exhaustion gap and this gap getting filled, this tells me that there is a little bit of a slowdown on a short-term basis, which may take us eventually, now may, but not necessarily will, right? There is no guarantee about that. But technically speaking, technical viewpoint is that if you get a proper exhaustion gap filled like that, and a support broken at the 90, which is also a crucial round number, then I would argue that this actual energy sector fund, can take us lower to the medium term trend, somewhere in the mid 80s, maybe low 80s, something like this. I'm saying it's not necessarily guaranteed or shouldn't be taken for granted at any time, mainly because we have unstable situation on the geopolitical side, right? We're talking about the very recent, burst of the rocket, of the bomb, somewhere on the Polish side, basically, right? So it's not 100%, I should say, clear or clarified, stated what happened exactly, but all we know is that two people were found dead because of the ballistic missile, basically exploding on the Polish side, coming from the Russia-Ukraine war. So, leaving out all the conspiracy theories aside, you don't know, what's going to happen. You don't know who sent this rocket, but what you know is that it's likely going to impact the markets one way or another, because we know that engagement on the Russia-Ukraine side on the war, this definitely addresses and impacts the distribution of the oil and of the energy, right? So typically it limits, it cuts down all the necessary resources, to help survive the winter, let's say, to the colder regions of the Europe. So there's very, very strict and distinct dependence on the oil side, on the energy side. So it may happen that if there is a limit cut, right, if there is a limit supply limitation basically coming up, then typically it overshoots, the prices of the energy to the upside. So again, we have a technical setup showing on the technical standpoint that the chances are that there's an exhaustion gap, that the short-term reversal might be pending, which eventually could be impacting the risk assets, empowering and fueling up again more rally on the stock side, right? At least the setup, it's kind of like the situation is there, that more bullish news or initiative is there. However, like I said, these geopolitical risk and tensions are definitely not to be ignored. I hope it makes sense. If we go further down the rabbit hole, then the next chart is the dollar, of course, right? We were looking at a significant decline on the dollar, and it's been a very sharp one. So first off, some time ago I was talking about this descending triangle pattern, right? This descending triangle pattern, which was basically forming a distribution pattern. Like I've thrown a couple of charts here and there, so you're going to probably like it if you scroll through my feed. But most important point is that this dollar is definitely following a medium-term retracement. This is not just a short-term correction like the ones that we've seen so far this year, but it's a proper shift. It's a proper change in the market, right? It's still a secondary movement because it's bouncing off the long-term trend defined by the 200-day average, but it's still, first instance of this pullback to the 200-day average in quite a long time, at least in the last, 5-6 months. Back to the levels, like I said, not seen since, July, if you will. So long story short, I think that this short-term trend represented by the green curve, by the 20-day average, as well as the as well as the bluish, this dark blue curve, medium-term trend, those are actually racing to the downside, right? One is crossing over another, more vertically, more steeply, in a steeper way, which basically tells you again that the short-term momentum is definite, that there's a lot of short-term downside pressures, which again broke dollar out of its medium-term pattern, right? So it's reversed not only the short-term trend to the downside, but you can tell just by watching, following where this green curve just goes. But we've also started seeing this inflection on the medium-term basis. So this tells me that this short-term correction is strong enough to reverse this medium-term trend, most likely. Even if it's for the short term, this is definitely a very, very strong one. Right. So less expensive dollar typically is more bullish for the economy, typically is more bullish for the risk assets, for stocks, for the cryptocurrencies overall, because of their inverse correlation. Whenever dollar is strong, Bitcoin tends to be weak. Whenever Bitcoin is weak, dollar tends to get strong, and the other way around for the stocks. So here, if we take it even further, then bond prices have actually broken to the upside as well. 30-year bond prices have broken to the upside following this double bottom pattern, a breakout successfully breaking over 20-day trend and breaking over 50-day trend. Again, significant shift because it's not only addressing and breaking over 50-day, 20-day mere periods of short-term movements, right? Anything between 3 days and 3 weeks. So basically 20 days kind of like as well is classified as a short-term trend, short-term direction, short-term narrative. Medium term narrative, medium term time frame lasts between 3 weeks and 3 months approximately. So 50 days is definitely classified for this average to be a medium term. So this also pulling back higher, I would argue this sets positively more bullish initiatives for stocks and for Bitcoin. Um, Mainly because of the inverse correlation, or I should say inverse relationship and negative correlation to the yields, to the interest rates. We know that the 10-year treasury note yield index basically is representing the traders' expectations for the what the yields are. Right, we are right now, we've come off the top from almost 45 down to 38, which shows you again as the significant change not only on the short-term trend side, right, as the short-term trend gets violated, but also it breaches the medium-term trend. So same story as with dollar. It is both short-term and medium-term impact that is likely going to be addressed, potentially taking us somewhere lower. However, traders' expectations are one thing, right? They often tend to make the trends, right? Trend to drive the trends up or down depending on what the expectations are, what the traders are pricing in for the future to look like. However, we should not forget that this is Fed and the FOMC committee board that basically decides about the interest rates directions, right? We know that the inflation recently has started coming off just a little bit. It definitely triggered a lot of bullish reaction on the market. However, we should not be taking it for granted. Like I said, there is definitely big gap between what we're looking at right now in terms of 7.7 inflation year over year, for October, or even somewhere in the 6% for the less energy and food for the core inflation. Overall, we are still talking about being way overshot over the target 2% rate of inflation, right? So this definitely has, is a lot of work to be done just yet. We're not out of the woods just yet. And it may happen that despite the good looking potential bullish technical setup, as in bearish for the yields, but bullish for the stocks, it may get reverted and interrupted at any time by the Fed, right? We don't know we don't know what's going to happen tomorrow. We don't know what the Fed's decision is going to be. We can just only hope for the best, and that it is actually going to bring a little bit of relaxation to the risk assets. Hope it makes sense so far. If we go further, then I would argue that what is worth taking away is that the relative rotation graph by Julius de Campanauer, who is the author, it shows, of course, the JDK relative momentum and JDK relative strength ratio. So it is benchmarked against the S&P 500, which is at the intersection of the axis now at 100 and 100. This is the point, right? So anything in terms of like all the S&P 500 sectors, SLE energy, plus Bitcoin, basic materials, communication services, real estate, our technology, the consumer discretionary and all of that, it's all benchmarked against the S&P 500, which is right there, and the intersection of 100 and 100, right? This is the basis. So we know that anything that is on the right side of the S&P 500 on the relative strength side, it trends or is trending in the relative upwards trend against the S&P 500. It means it's outperforming. And we know that based on the momentum principle, the issues, the securities that tend to outperform, that are leading in the leading quadrant, basically are more likely to continue to outperform rather than to reverse because of momentum, right? Momentum is this money moving towards specific direction. And just like a big truck, just basically, rallying very fast, it's very hard to stop it. Eventually, if you take the foot off the gas, leaving no foot on the brake, it's going to slow down and stop itself, right? But it first needs to lose its own impetum. It needs to lose its own momentum. And when it does so, that's when it's kind of, just stops and reverses, just for instance, if it has the option to do so. But all that is important to say and to mention, mainly because we are looking at a strong and distinct leadership, leading quadrant, very strong momentum, relative momentum, which is the ROC, rate of change of how fast the relative strength changes, and the strong relative strength, right? So this tells me again that XLE, that the energy is heavily outperforming the S&P 500 and not all the other basically baskets, but it's also strong on the relative strength side, right? So it's relative upward strength and also relative momentum. Those are strong. and definitely very very significant. We are looking at utilities, taking a hit there, moving to the lagging quadrant. We're talking about consumer discretionary, right? Moving towards lagging quadrant. Those two typically move in the opposite directions a little bit. So most likely it's related to strong energy leadership and the dollar overall strength. But what I would argue is important is that driven by the strong again performance, this definite bullish trend and the breakout over to long-term bear market, on the Dow Jones Industrials, we're looking at the basic materials basically also improving heavily and aggressively. We're talking about the XLI, which is the industrials. All of that is actually just moving and pointing towards the leading, either improving or leading quadrant. So this tells me again that overall we're looking at a situation where the short term there's a little bit of this mix up, right? You're looking at the situation where the defensive stocks are losing a little bit of power. There's a little bit of this differentiation within the defensive stocks. The energy is still very strong. Dollar has taken a hit a little bit. It's taken a hit a little bit to the downside. Yields are cooling off just a little bit was a reaction to it as well. Bond prices are reversing, potentially promising for cryptocurrencies, for stocks. However, remember that the Fed reduces the balance sheet by selling off securities, by selling off bonds up there, treasuries. I mean, selling bonds, and this way they actually just again using their inverse relationship. Selling off bonds definitely decreases the bond prices and at the same time pushes the interest rates higher, right? So this is what defines this overall interest rate policy. So let's not forget about that. And finally, Bitcoin is actually looking at this very strong and significant change, right? This very strong and significant change is different mainly because for the first time this year, we are looking, or actually first time, in quite a long time, because we've already got those situations, at the strongly negative correlation between Bitcoin and S&P 500. Strongly negative correlation means that at minus 0.54 for the 7-week correlation coefficient, most of the time on the 7-week basis, on average, Bitcoin tends to follow the opposite direction than the stocks. And of course, it makes sense, right? Because if you follow what Bitcoin has been doing, that we kept breaking to the downside, especially fueled by the FTX collapse, right? So at times when there's an FTX collapse, it can make this impact that it kind of like dissects, and then changes the proportions and the relationships between certain markets. And so that, the FTX didn't necessarily impact the stocks, which kept rallying higher, but it did impact Bitcoin, which actually, again, provided a lot of mess and a lot of FUD and a lot of uncertainty and a lot of sell-offs. So having this strong inverse correlation, I would argue this negative correlation coefficient tells me that it's, first of all, strongest in quite a long time. It's strongest in almost a year and a half. The last time it was this strong, it was July Q2 2021. Which is pretty interesting, right? So it's definitely a breakthrough moment. It's a strong breakout record for Bitcoin to face. Eventually, Bitcoin likes to follow the same direction for most of the time. You can see that whenever this situation happens, it doesn't remain long in here, right? Most of the very biggest congestion, vast majority of the time, it spends in the upper section where Bitcoin is positively correlated to stocks or web stocks. Right, so they tend to follow the same directions. So stocks pushing higher eventually is potentially bullish for crypto. However, we first have to tackle this FTX situation because this is definitely what's taking the attention away from the traders who lost tons of money, right? And even if we go to the recent NUPL studies, I'll try to actually bring it here right now. Then I would argue we're looking at the market being heavily underwater, right? So overall, you're looking at this at the pattern where net unrealized profit or loss, in this case net unrealized loss, we are underwater. There is about 0.3 ratio to the downside that we are underwater on average. The average NUPL ratio, net unrealized profit and loss, net unrealized loss, is definitely tilting aggressively to the downside, right? Let me actually just highlight the color a little bit more here, right? So this type of capitulation and this overall profitability on the market, where the traders on average were net positive or net neutral, right here at the zero line. Right now, they are definitely, most of the market is on average heavily underwater, right, at the significant rates, and this um, brings and generates contrarian opportunities, because most of the time such pattern came in, right, as a strong, heavily deviated underwater situation for the market. This often was followed and was preceding massive reversals, right? So of course we don't know if it's going to happen like that. There's a little bit of a small sample in here. We only have a couple of instances here. So the bigger the sample, the more accurate the data and the conclusions. So I wouldn't far fetch any sort of like big promises for the reversal. But what I'm saying is that typically, so far, that whenever the market reverses to the upside and the bear market ends, it ends not within the positive NUPL ratio, but in the negative values, which is what we are looking at right now here. Other than this, I hope it makes sense. Um, I still want to give you guys a little bit of the fresh understanding for why I think $12,000 should be on your chart. Marked mainly, and long story short, it is because this is a technical breakout target, right? We definitely have seen this massive, significant pattern breakdown, where we're looking at this descending triangle overall, stretching between 17,500 all the way up to 25K, right? Which brings almost $7,000-8,000 of a range potential. So which is what we take away, right? What we take or less from the breakout level. So this measured rule move basically tells me that, again, if we take this pattern size, this base size, and take it, apply the measured move, this places us somewhere around $12,000, right? So this pattern taking us towards $12,000, this definitely comes with technical objectives, right? Now, again, I don't know if it's going to happen. I have no idea what's going to happen tomorrow. If we all wake up, or if there's this nuclear war, we don't know that, right? No charts are going to tell you this. No charts are going to tell you about the next exchange collapse, right? No exchange like the FTX. So, long story short, we know that the technical targets tend to be looked at. We know that many traders are looking at the same charts, and on the self-fulfilling prophecy basis, because many people tend to see the same patterns and the same targets in the charts. This is why the chart may actually gravitate slowly towards this region, right? Of course, if it happens, then then it's going to be significant crash in the market, and this sort of like, again, probably even more exchanges collapsing. You don't know what's around the corner. You have to be ready for it. I'm just saying that it's worth typically to be prepared for the worst case scenario, right? If you're hoping for the best, but get ready for the worst, and that's how you're covered. So that is just why I would imagine I would definitely have my $12,000 target on the bingo card here. I'm not saying it will happen, right? But it's something to worth definitely noting, in my opinion. So far, 75% down year to date. Maximum drawdown from Bitcoin at 77%. Bitcoin typically follows those 80-85% retracements, which would place a perfect target also at 82%. Another reason why we should be looking there. Again, otherwise, the bear market cancellation and the bull market breakout comes above 200-day average. And like I mentioned, remember, Dow Jones Industrials is above it, 200-day mean trend already. Bitcoin is far heavily deviated to the downside. So as soon as it breaks to the upside for the first time this year, over 200-day average, this is where we can talk about the confirmed bull market reversal. Until then, the bull market is not really on the table. The bear market is the main narrative, is the dominant tendency, dominant trend, and that's where the money is moving in this direction, right? So counter trading this eventually may not necessarily be the best and the most profitable technique, if you will. So all that is to say, everybody, that we're not out of the woods, right? And we're not out of the woods just yet. Crypto is looking far worse than stocks are, but stocks looking positive much more than not is definitely something to mind, something to look at, because it's lining and preparing this positive soil, this good fertile soil for crypto to grow on, right? We're not there yet, but as soon as we manage, as the market, as the crypto industry, to fix and actually just process what's happened after the FTX, and maybe again allow for a couple more other exchange collapses. Then following, even miners capitulation, reminder the miners are right now trading, are moving with an unprofitable business right now. They are running unprofitable business, right? Average mining cost is around $20,000. Right now, we're talking about prices at 16, 17, 16,500s. So it means they are operating under the water. And they're operating underwater. And operating underwater means that they cannot run unprofitable business for a long time. So there's a specific threshold below which, on the Bitcoin chart, there's likely bigger chance of seeing this capitulation cascade, that traders sell off, stop loss trigger, and miners need to capitulate because they have to close their mines. So know what that happens, but this situation where the Murphy law just starts to act, and anything that can go wrong just goes wrong, such a black swan event for crypto. This may happen. And you're going to see tons of pain. Again, exchanges collapsing, biggest projects collapsing, crypto going, dead, quote unquote, right? Just like media would frame it. Bitcoin's up $15,000, maybe 10, maybe 12, who knows? Just saying again, hope for the best, be ready for the worst. That is what I think is the best case. And finally, to help you prepare for all this madness, we are hosting Free Trading Congress next week, starting in 3 days on Monday for 7 days for everybody who registers on the website, thebermness.com/congress. You're going to be able to take part in tons of valuable workshops with amazing speakers. We've got really great lineup this year with tons of professional speakers, big names in the industry, with tons of practical tips, how we can actually, process what's happened, how we can improve, manage all the losses, make up for all the losses, and actually prepare for what's coming in 2023, because there is going to be tons of interesting aspects to it. I'm inviting you guys to take part in this free trading congress. Typically, competitors and all the other like exchange promoted conferences, they're going to charge you typically $3,000, right? Token 2049 was really, somewhere close like 2,500 pounds. Those are like some sig numbers for 2 days, and we're talking about 7-day experience for free, completely free of charge, coming with tons of value, tons of webinars, and free access, limited access to our premium membership. So this is a little bit like an open day. If you accept this invitation, you stand the chance to actually make up and recover losses faster of the bear market. I know that this has definitely been painful for the vast majority of the people and traders. This translates to a lot of pain, a lot of uncertainty, and a lot of problems, especially on the financial and on the emotional side. But I'm just, again, trying to give you a reach out with a helping hand, regardless you take it or not, regardless you stay with the nest for longer or not after this congress ends. I just want to give you the chance to recover. If you take it, go to thebermnest.com/congress. Thebermnest.com/congress. I'm going to put it in the video description on YouTube. So make sure you also appreciate it. If you appreciate it, then hit the likes, hit the like button, hit the thumbs up, hit the notification bells on, so that you stay tuned. We are going to start hosting the congress really, really soon. If you have not signed up yet, but you want to see if you qualify and actually put your name on the registration list, go to thebermnest.com/congress, and that's where it starts. Hope it helps everybody. Stay safe. God bless you all. And I wish you a pleasant week. Stay safe, and I see you around.